When you buy a share of stock, the math is simple. One share equals 1 unit of ownership. If the stock goes up $10, you make $10. If it drops, you lose exactly what it dropped. Your risk is locked in a one-to-one straight line. Options break that linear math. Instead of buying shares outright, you buy a derivative contract. A single standard option contract controls 100 shares of the underlying stock, giving you leverage without requiring you to actually own the asset. This creates asymmetric payoffs. You can structure trades where your potential losses are strictly capped, but your potential gains are left wide open. Or you can do the exact opposite. That structure forces a choice. You either pay an upfront cash premium for the right to capture speculative upside, or you act as the insurer, collecting a premium today in exchange for taking on the downside risk if things go wrong. Because these contracts have expiration dates, time works against you. You can guess the stock's direction perfectly, but if the move happens one day after your contract expires, you lose everything you put in. Surviving this market means strictly defining your risk before you ever place a trade. Open an options chain, and you will see thousands of variations for a single stock. There are dozens of strike prices, spread across weekly, monthly, and yearly expiration dates. Pick an incredibly obscure combination, an Apple call in 17 days, at a bizarre strike price, and click Buy. Your order fills in a fraction of a second. There isn't another retail trader sitting at their computer, waiting to take the exact opposite side of that highly specific trade at that exact moment. Your counterparty is a market maker. These are massive institutional algorithms designed to quote both buy and sell prices simultaneously. They exist to absorb market imbalances, acting as the universal buyer when you want to sell and the seller when you want to buy. To understand the options you are trading, you have to understand the mechanics of the entity taking the other side of your bet. They provide the liquidity that makes the entire system possible. Let's look at the most common speculative trade, the long call. You pay an upfront cash premium for the right, but not the obligation, to buy 100 shares of a stock at a specific target or strike price before a set date. The risk here is tightly defined. The absolute maximum you can lose is the exact dollar amount of the premium you paid to enter the trade. If the stock crashes, you simply let the contract expire worthless. On the other hand, the profit potential has no ceiling. If the underlying stock surges past your strike price, the value of your contract scales up right alongside it. This chart plots an Apple call. The upward blue line shows profit climbing indefinitely as price increases. Notice where it crosses the zero axis. You only profit when the stock surpasses your strike price plus the premium paid. That gap is your break-even point. You accept a statistically low probability of success because the stock has to move significantly in a short amount of time, in exchange for strictly capped risk and outsized leverage if you are right. The inverse of this is the short put. Here, you act as the seller. You collect cash up front, and in return, you take on the strict obligation to buy 100 shares of the stock at the strike price if the buyer decides to exercise their contract. Traders use this strategy to generate yield. The stock doesn't even need to go up for you to win. As long as it stays flat or doesn't drop below your strike price by expiration, you keep the cash. The trade-off is that your gains are hard-capped. It doesn't matter if the stock price triples next month. The absolute maximum profit you'll ever see is the initial premium collected on day one. The downside exposure is massive. If the stock plunges, you are legally obligated to buy those falling shares at the originally agreed-upon high strike price. This short put graph shows a flat blue line top right, your locked-in maximum profit. Compare that to the steep downward slope on the left. In the table, a slight drop to $118 accelerates losses to $149, instantly wiping out your small premium collected. The short put offers a high probability of a small win, but it requires deep pockets. You are trading away your upside to take on intense asymmetric downside risk if the market turns against you. Remember the core rule of this ecosystem. For every call bought and every put sold, someone is taking the opposite side of the trade. The market is heavily skewed. Large institutions constantly buy puts as insurance for their portfolios. Meanwhile, retail traders heavily favor buying calls to speculate on growth. Market makers absorb unbalanced portfolios, taking the opposite side of your bets. To avoid directional risk and profit purely from transaction fees, they use delta hedging, constantly buying or selling shares of the underlying stock to neutralize their options exposure. The scale of this operation is staggering. Market makers routinely must buy or sell hundreds of millions of dollars worth of equities overnight simply to remain neutral on their options inventory. That forced, mechanical buying and selling of the underlying asset physically drives the stock's price up or down. Options activity has evolved into a primary driver of overall stock market volatility, forcing the underlying asset to react to the derivative. Delta hedging reveals the underlying reality. Through the mechanical reactions of market makers, the options market physically dictates the movement of the underlying stock. So how do you translate these mechanics to your own account? It comes down to matching the right strategy to your actual financial reality. We can map it out on a simple matrix. On the bottom, your available capital and risk tolerance, from low to high. On the side, your market outlook, from neutral to highly bullish. If you fall into the top left, you have a strong bullish thesis but limited capital. Your tool is the long call. This limits your maximum loss to a defined premium, protecting smaller accounts from total ruin. But to overcome the cost of that premium, your stock thesis needs to be aggressively correct and happen within a strict time frame. Conversely, if you sit in the bottom right, you have a neutral outlook and significant cash. Your tool is selling puts. This strategy is strictly for large accounts that actually have the cash sitting in reserve to buy 100 shares of the stock if assigned. It puts dormant capital to work generating yield in a flat market. Financial devastation in options trading almost always stems from a matrix mismatch. Specifically, traders with low capital trying to act like institutions by selling options, getting caught by the steamroller risk of an unexpected market drop. The options market is a highly efficient, zero-sum ecosystem of risk transfer. It is not a machine for free leverage. Every time you enjoy the convenience of instant order execution, a massive institutional algorithm has analyzed your risk profile, taken the other side of your bet, and immediately hedged against you. Success here doesn't come from outsmarting those institutions. It comes from rigorously defining and accepting your own risk parameters before your money ever hits the table. Long-term success requires mastering your own capital, patience, and precise role within the financial ecosystem, rather than simply guessing stock directions.